Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
All right, so we are analyzing Roblox Corporation, ticker RBLX. It's trading pretty robustly around, $82.57 as of mid-January 2026. The stock's seen, a lot of implied volatility, reacting sharply to options expirations with these big volume spikes, yet it's holding onto a really formidable market cap of about $55.7 billion. I mean, the tension around Roblox really defines this paradox of modern tech. On one hand, you see operational scale that just seems unstoppable. 151.5 million daily active users, that's up 70% year over year, bookings surging 70%. But on the other hand, the company it's plagued by this profitless prosperity critique. We saw a $257.4 million GAAP net loss in Q3 2025, and then you have these genuinely existential regulatory threats. So the real question is this: does the current $82 price fundamentally undervalue Roblox's position as a dominant, almost irreplaceable social utility? Or does it rationally reflect the platform's structural flaws and these catastrophic regulatory time bombs that are just ticking away? I'm firmly on the side that the market is severely underestimating the platform's scale and the long-term potential of its user-generated content economics.
And I come at it from a different perspective entirely. For me, that 82.57 valuation represents a premium that is it's simply not supported by the underlying unit economics. We are, in effect, pricing in absolute perfection for a company that seems structurally incapable of achieving sustainable, profitable scale. So while I respect the sheer velocity of the user growth, you can't argue with those numbers, I believe that valuation premium is completely unsustainable, especially given the structural margin compression management has already started talking about for 2026, combined with the severity and breadth of its unquantified regulatory exposure.
My bullish position is really built squarely on dominance and platform economics. Reaching 151.5 million DAOs isn't just a high watermark. It cements RBLX as a critical utility. It's a primary digital gathering space for Gen Z and Gen Alpha, globally. And that dominance, in my view, justifies the exceptionally high price-to-sales multiple. We're talking around 12.8 times trailing 12 months revenue. For context, you look at established, profitable gaming peers like Electronic Arts, they trade at half that, about 6.0 XPS. The premium is warranted because of the scalable UGC model. Unlike traditional media or gaming, Roblox offloads the cost and, the labor of content generation to its community. This theoretically allows for infinite content growth at a minimal marginal cost to the platform holder. The near-term gap losses you're pointing to, they're just necessary, aggressive reinvestments.
They're funding the massive infrastructure for the metaverse and, crucially, developing the AI moderation tools needed to solve the trust and safety cost crisis long-term. Analyst consensus targets, which, they hover around $134, with some bulls like Goldman Sachs suggesting up to $180. That signals the market sees significant upside once that operational leverage, which is inevitable in a closed platform, begins to kick in.
I'm sorry, I don't buy that theory of eventual low-cost scalability. The valuation is priced for leverage that the company itself is already admitting it can't achieve. Management forecasting margin compression in 2026 that is a massive red flag. It tells us the profitless growth paradox is structural. It's not cyclical. The essential costs of this ecosystem, hosting these complex 3D real-time worlds and, most critically, the trust and safety apparatus, they scale linearly, maybe even superlinearly with user growth. You need armies of human moderators and very expensive cutting-edge AI systems to police 150 million users, and many of them are minors. This cost structure fundamentally prevents the platform from ever achieving the 80 or 90% gross margins you see in true software-as-a-service platforms. The kind of margins that justify a 12.8 XPS multiple. And beyond that, the company faces severe unquantified liability from catastrophic regulatory intervention. We're talking about lawsuits filed by multiple state attorneys general, Kentucky, Louisiana, Tennessee, Texas, all alleging the platform exploits children. This is an existential risk. Because if courts mandate operational restrictions like, say, disabling communication features for minors, the core engagement loop and the unit economics would be completely shattered. This stock is priced like a hyper-growth tech platform, but it operates with the risks and the heavy capital requirements of a high-end gaming company. Any realistic repricing toward traditional gaming multiples of, 5 to 6 times PS, that implies a massive downside. It could potentially drop the stock into the $40 to $50 range.
I see why you focus on the immediate GAAP results and the headline risks, but let's delve into the actual financials for a clearer operational picture. Focusing only on the GAAP net losses, that $257.4 million in Q3, it obscures the crucial operational strength that's indicated by free cash flow, or FCF. FCF was positive at a robust $442.6 million in that same quarter. FCF is the actual cash the business operations are generating.
But you have to acknowledge that FCF is heavily bolstered by adding back stock-based compensation, SBC, which is really just the cash equivalent of paying your talent in equity. That is not free cash flow in the classical sense of shareholder benefit.
Okay, I do concede that FCF is flattered by SBC, which, yes, it leads to dilution of the existing shareholder base. But we have to view that dilution as a necessary non-cash cost of retaining the very specific high-end engineering talent you need to build out the metaverse. It is an expense, a significant one mathematically, but it isn't an immediate drain on the operational liquidity needed to run the platform, which is what FCF measures. Your argument suggests the platform is inherently lower margin because of developer payouts, DevEx, and trust and safety costs. I would frame that cost structure differently by comparing RBLX to its peers. Roblox controls the entire stack: the game engine, the distribution, the monetization, and the social graph. That closed platform, that walled garden, it gives it superior economics compared to pure engine plays like Unity software. Unity has struggled immensely with monetization and, crucially, distribution. And the result is a depressed valuation trading at only around 4.5x PS. The market is clearly rewarding RBLX's ability to capture 30 to 70% of every transaction in its ecosystem precisely because they control every part of the funnel. That justifies this PS premium over competitors who lack that vertical integration.
That's a compelling point on vertical integration, but superior economics still demand operating leverage, and that's what's missing. Let's stay on the financial drag of SBC for a second. The share count has ballooned from roughly 596 million in 2022 to over 701 million shares outstanding in early 2026. This is a constant year-over-year inflation of the share base. It's a silent but powerful tax on shareholders that mathematically undercuts any future EPS growth, which is exactly the ammunition the short thesis relies on. FCF is positive, yes, but only because you're funding talent with future equity value, not current cash. And the structural constraints from the DevEx payouts are, well, they're non-negotiable and they're massive. DevEx is a core cost of the UGC model.
Unlike a true software subscription business where the marginal cost of the next user is basically zero, RBLX has to constantly funnel a huge portion of its revenue, around 25% or more, back to creators, just to generate the content. This constant revenue share prevents the kind of operational leverage a high multiple tech stock demand. When a platform with 150 million DAUs forecast margin compression instead of expansion, it suggests the model is inherently low margin, which makes a 12.8x PS multiple unjustifiable. And this financial pressure is only compounded by the regulatory time bomb. We really have to focus on the scale of the moral hazard and the damaging headline risk that feeds directly into that regulatory machine. We saw the intense negative reaction to the CEO David Baszucki's infamous opportunity gaffe when he discussed predatory behavior on the platform. Critics immediately seized on this, suggesting the company prioritizes platform optimization over its moral responsibility. And worse was the PR disaster of the Schlep ban, silencing a content creator who was effectively acting as a whistleblower, exposing illicit activity. These incidents are not minor. They fuel the political will for regulatory action. The multi-state AG lawsuits aren't just seeking financial penalties. They're seeking what's called injunctive relief.
And could you maybe just clarify the significance of injunctive relief for our listeners?
Absolutely. Injunctive relief means the courts could order fundamental, mandatory operational changes, not just a fine. For example, they might mandate strict onerous age verification. Or, more destructively, mandate disabling communication features like in-game chat for all minors. If Roblox is forced to severely hamper communication, the social serendipity, that spontaneous, real-time interaction that drives engagement, would be severely hampered. The platform would just devolve into a sterile collection of separate minigames, and that fundamentally threatens the core social utility function that defines Roblox. The stock is simply not priced for this kind of operational risk.
I do acknowledge that the reputational damage and the legal headwinds are serious, especially around the Schlepp incident, which was handled, well, poorly, to say the least. However, this type of regulatory intervention is a risk that is routinely priced into high-growth, consumer-facing tech companies at this scale. If the market genuinely believed this risk was existential, we would see far more dramatic signs of skepticism. Just consider the technicals. Short interest stands at a modest 2.23% to 2.4% of the float. That's about 14 to 15 million shares shorted. And crucially, the days to cover ratio is low, between 1.38 and 2.03 days. That does not signal an imminent short squeeze or overwhelming bearish conviction. This suggests professional skeptics see the current risk as manageable or already contained in the valuation. And we can't ignore the corporate governance structure, the dual-class shares. CEO Bazuki owns 100% of the Class B shares, giving him 20 votes per share, which ensures management stability and control.
But that stability is a double-edged sword, isn't it? It means the CEO is insulated from shareholder pressure. While you argue this ensures a long-term play can continue, it also means there's little recourse for investors if management makes a catastrophic error or just fails to adequately address these regulatory firestorms. That insulation actually increases the operational risk when the company is facing an existential threat. And speaking of internal confidence, the actions of the executives themselves suggest they view the $82 price point as, well, generous.
What specific actions are you referring to there?
Well, we saw significant insider selling in December of 2025. Both Bazuchi and the lead independent director, Anthony Lee, were offloading millions in Class A stock under Rule 10b-5. One plan. Now, while these are pre-scheduled plans, to avoid accusations of insider trading, the sheer volume and the timing right near the valuation highs suggests management views the current $82 plus valuation as either fully priced or perhaps they're anticipating the very headwinds they forecasted for 2026. That lack of conviction from the top is a powerful technical warning. And we also see worrying signals in the engagement metrics. The hours engaged metric, which is the lifeblood of the platform, it grew 74% year over year in December 2025. That sounds impressive, yes, but it represents a notable deceleration from 110% growth in October. This slowing trend suggests the pandemic-era surge is normalizing faster than people thought. If engagement growth decelerates toward traditional gaming rates of, say, 10 to 15%, the entire bull thesis just collapses, and that 12.8x PS multiple has to collapse with it.
Insider sales can be a warning sign, sure, but we shouldn't overread pre-scheduled divestitures that are for portfolio diversification. What is not ambiguous is the high-conviction institutional ownership. Vanguard, one of the largest passive holders, increased its stake to nearly 9%. That's roughly 62 million shares in late 2025. This signals confidence in the platform's durability. Furthermore, investor sentiment is highly polarized, which reflects the binary nature of this stock, but the trading activity indicates technical support. While X might be negative because of the PR crises, stock-to-its sentiment actually shifted decisively to bullish in mid-January. Active traders clearly see the $76 to $80 level as a technical floor for a bounce.
The market understands the risk here and is already pricing in volatility. The implied volatility in near-term options was extremely high, 333.9% IV recorded just before the last expiry. That high IV shows sophisticated participants were bracing for massive price swings, suggesting they were paying for the optionality inherent in 150 million highly engaged users. The market is paying a premium for the possibility that Roblox successfully executes its AI-driven cost reduction plan. So, to briefly summarize our discussion before we wrap, The core tension remains deeply entrenched. I view Roblox as an irreplaceable, dominant utility. Its monumental scale of 151.5 million users and its inherently superior vertically integrated UGC economic model, well, they fundamentally justify a hypergrowth valuation, that 12.8x PS, despite the acknowledged friction from short-term margin compression and dilution.
The current spending is an investment necessary to secure long-term dominance.
And conversely, I maintain that the 82.57 stock price is dramatically overvalued because the company is structurally flawed. The necessity of linear cost scaling for trust and safety in DevEx, the ongoing shareholder dilution through SBC, and the catastrophic unquantified legal exposure from these multi-state AG lawsuits, it all means the risk of a massive repricing toward traditional gaming multiples is simply too high to warrant the current premium. The platform just can't generate SaaS-like margins.
Right, and the enormous divergence in analyst targets, which span a range of over $110 from lows around 70 to highs of 180, that just perfectly reflects the absolute binary nature of this investment. The survival of Roblox as a premium asset really hinges entirely on whether management can successfully deploy AI and advanced technology to solve the structural cost crisis in trust and safety, and crucially navigate this hostile, politically charged regulatory landscape through 2026.
Ultimately, the listener has to weigh the platform's undeniable cultural relevance and market dominance, its incredible reach into youth demographics, against its severe financial vulnerabilities and potentially crippling legal liabilities. Determining whether the valuation risk is worth the potential reward, well, it requires a highly nuanced assessment of whether they believe technology can solve what is, at its core, an inherently human and moral problem.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.